Why do banks pay us interest while they have to work so hard to save our money? Because every bank is legally permitted to print money. The illusion of finite money. The belief that money is finite is deeply ingrained in our society. We tend to think of money as a limited resource with only a set amount in circulation. This perception can lead to a scarcity mindset, where people believe that there's not enough money to go around. This, in turn, can cause fear, competition, and financial insecurity. In reality, money is not a finite resource. It is a dynamic and expandable concept. It is created and controlled by central banks, such as the Federal Reserve in the United States or the European Central Bank in the Eurozone. These institutions have the authority to issue currency and regulate the money supply. When you deposit money in your bank account, it doesn't sit in a vault somewhere waiting for you to withdraw it. Instead, the bank lends most of that money out to borrowers. This is where the magic of money creation happens. Let's consider a simplified example. You deposit $1,000 into your bank account. The bank is required to keep a fraction of this deposit on reserve, typically around 10%. In this case, that's $100. The remaining $900 can be lent out to others, such as individuals, businesses, or even the government. Now, here's the intriguing part. When the bank lends out that $900, it becomes a deposit in someone else's account. This means that the initial $1,000 deposit has effectively turned into $1,900 in the banking system. Fractional reserve system. It is the cornerstone of modern banking. In this system, banks are only required to hold a fraction of the deposits they receive in reserve, which they can lend out to create new money. This fractional reserve requirement varies by country and is set by the central bank. The fractional reserve system enables the banking system to multiply the money supply far beyond the actual physical currency in circulation. While it's a fundamental aspect of the modern financial system, it can also be a source of economic instability. The expansion of the money supply through the fractional reserve system has significant economic implications. When banks create new money by lending, it can stimulate economic growth. However, it can also lead to inflation if the money supply expands too rapidly. This is because the more money there is in circulation, the less valuable each unit of money becomes, causing prices to rise. Conversely, if too many people withdraw their money from banks simultaneously, it can lead to a contraction of the money supply, potentially triggering economic recessions or even depressions. This is what happened during the Great Depression in the 1930s, when bank runs caused a severe contraction of the money supply to manage these potential issues. Central banks play a crucial role. They control the money supply through various tools, including open market operations, reserve requirements, and interest rate policies. Central banks aim to strike a delicate balance between stimulating economic growth and controlling inflation, often referred to as the dual mandate. The process doesn't stop there. The money lent out to someone else eventually finds its way into another bank, where it becomes a deposit. That bank is then allowed to lend out a fraction of it, creating new money in the process. This chain reaction continues, and the money supply expands far beyond the initial deposit. This is known as the money multiplier effect. The fractional reserve system enables banks to create money by lending out your deposits, effectively multiplying the money supply. This practice, while essential for economic growth, is not without its challenges. The fractional reserve system is a double-edged sword, with both positive and negative aspects. 1. Economic growth by creating new money through lending. The fractional reserve system stimulates economic activity. It provides the financial fuel that drives businesses, investments, and entrepreneurship. Banks play a crucial role in the economy by channeling funds from savers to borrowers. They provide loans for people buying homes, businesses investing in expansion, and governments funding public projects. The system allows banks to offer interest on your deposits and charge interest on loans. 1. Potential instability. The very feature that stimulates growth can also lead to instability. If too many depositors demand their money simultaneously, a bank run, banks may not have enough cash on hand to meet those demands, leading to a financial crisis. Inflation and asset bubbles. When the money supply expands too rapidly due to excessive lending, it can lead to inflation, which erodes the purchasing power of money. Furthermore, easy access to credit can inflate asset prices, leading to bubbles in real estate or financial market. Regulators must carefully oversee the banking system to prevent excessive risk-taking or fraud. This requires a fine balance between allowing banks to operate freely and protecting the interests of depositors and the overall economy. The fractional reserve system isn't a new phenomenon. It has existed in various forms for centuries. However, it has evolved with the changing financial landscape. Throughout history, there have been instances of financial panics and crises caused by bank runs and unsustainable lending practices. Understanding the fractional reserve system is crucial for anyone interested in the world of finance and banking. I hope this video helps you. Thank you so much for watching till the end.